All right, let's get right into it. If you're gearing up for your corporate governance and auditing exams, you are exactly where you need to be. Today, we're putting together the ultimate high-yield masterclass. We're going to decode the whole complex web of audit and internal control, and we're stripping away all that heavy academic jargon to give you a clear, structured framework in plain English. I know firsthand how dense these textbooks can get, right? So our goal today is to give you the exact mental models and real-world examples that examiners absolutely love to see. Okay, let's dive in. So, here's our roadmap for today. We'll start with the watchdogs of internal audit, tackle independence threats, and look at exactly how to respond to findings. After that, we'll cover control reporting and then wrap the whole thing up with financial and sustainability controls. Okay, Section 1. The watchdogs, internal audit, and committees. Think of a corporation like a living, breathing organism. If that's the case, internal controls are basically its immune system. They're the independent, objective activities designed to actively protect the organization from catastrophic risks. You definitely want to memorize this visual framework for your exam. Notice how it flows, starting right at the top. The board of directors assess risk. They decide if they're going to transfer, avoid, accept, or reduce that risk using internal controls. But here's the kicker. Who checks if those controls actually work? Well, that's where the internal audit function comes in at the bottom. They review the controls and report directly up to the audit committee, which oversees the entire process. It's this direct, unfiltered line of reporting that keeps the whole system honest. Now, you might be wondering, does every single company out there actually need an internal audit department? This right here is an examiner's absolute favorite topic. You have to look at factors like the scale and complexity of the business, the headcount, and any recent structural changes or system glitches. In places like the UK, which operates on a comply or explain model, smaller listed companies aren't legally forced to have one. They just have to weigh the cost-benefit. And if they decide the costs outweigh the benefits, fine, but they have to explain that decision super clearly in their annual report. Moving right along to Section 2, independence and objectivity threats. Look, as an auditor, being technically proficient just isn't enough. You must be completely objective. Examiners love testing your ability to spot when an auditor's judgment is compromised. To really cement this in your memory, consider this shocking real-world scandal. Back in 2016, Ernst & Young agreed to pay a massive $9.3 million to settle claims. Why? Well, one engagement partner racked up nearly $100,000 socializing with a client company's CFO and their family. And another partner was actually involved in a romantic relationship with a chief accounting officer. It perfectly and kind of wildly illustrates what happens when the line between auditor and client blurs. Investors need to trust financial statements, and that trust literally evaporates when objectivity is compromised. So, the real question is, how do we proactively protect that objectivity? The Institute of Internal Auditors Code of Ethics is super clear on this. Auditors have to actively decline any activity that might impair their unbiased assessment. They absolutely must disclose all material facts that could distort a report. And practically speaking, no lazy boilerplate communication. They have to communicate honestly and transparently, basically ensuring there are zero surprises for the board or the shareholders. Definitely write that down for the exam. Absolutely no surprises. I want to pause here for a second and test your critical thinking with a classic exam-style prompt. Imagine your CEO wants to ignore a newly discovered control deficiency simply because it's quote-unquote too expensive to fix. How do you respond? Think about the free works we just talked about. What is your fundamental responsibility as an auditor in that moment? Which leads us perfectly into Section 3, responding to audit findings. When an issue is flagged, like our theoretical CEO's expensive deficiency, management has to create a written management response. And here is a golden rule for your exam. Doing absolutely nothing is actually interpreted as a control deficiency itself. When you're asked to draft a management response on a test, avoid the trap of being vague. Look at this comparison. A totally poor, cringeworthy answer is just writing, records were updated. I mean, when, how, by who. Now, a top-tier, high-scoring answer looks like this. Unit supervisors will document policies for their respective processes by the end of Q1 20XX, and we will consolidate these into a user manual available to all staff. It's brilliant because it identifies exactly who is accountable, gives a realistic timetable, and commits to a concrete action. Let's ground this with a fantastic case study directly from the source text, the Regional Fire and Rescue Service. The internal audit found 3 massive IT failures here. First, weak access controls with 0 password limits, which frankly is absurd. Second, a crazy number of everyday users holding full domain administrator powers. And third, an IT security policy that hadn't been updated in 5 long years. Now, here is your exam strategy. The auditors, in that case, recommended setting intense 28-digit alphanumeric passwords. As a manager, you shouldn't just blindly agree to that. Literally nobody would be able to log in to do their jobs. Professional evaluation means balancing risks with operational reality. A credible response would be to counterpropose, say, a 12-character password limit. That protects security without grinding the business to a halt. Similarly, rather than completely eliminating all those domain administrators overnight and causing chaos, you suggest reducing them to an acceptable level over the financial year. This shows the examiner you actually understand real-world business context. All right, Section 4, Internal Control Reporting. So once we actually fix our controls internally, how do we communicate that to the world? Warning bells here, folks. This is a classic trap set by examiners, so pay close attention. Do not confuse these two types of reports. A report to management is completely internal. It digs into the nitty-gritty of specific control deficiencies and the actions needed to fix them. A report to shareholders, on the flip side, is an external document that goes into the annual report. It provides a high-level, balanced assessment of the overall effectiveness of the company's risk management across the entire year. When the board drafts that external statement to shareholders, there are strict requirements they have to follow. We can look at BT Group PLC's 2016 annual report as a real gold standard for this. The board has to explicitly acknowledge its responsibility for internal controls, but most importantly, they must explain that control systems are designed to manage, not completely eliminate risk. They can only provide reasonable assurance, not absolute assurance, against material misstatement or loss. Please, drill that phrase into your head, reasonable assurance. And finally, Section 5, Financial and Sustainability Reporting. When we're looking at reporting, you really need to master this highly testable contrast between preventive and detective controls. Preventive controls act like a locked door. They're there to stop unauthorized activity before it even happens. Think system passwords or segregating duties so no single person can both authorize and execute a payment. Detective controls, though, act like a burglar alarm. They identify errors after they've already occurred, so you can jump in and fix them. Things like doing your bank reconciliations or having managers actively review performance reports. Speaking of management reviews, picture this scenario from our source material. An internal audit finds that 40% of managers are just not reviewing their monthly management reports. You should instantly recognize that as a massive red flag. Comparing actual financial results to the budget is a critical detective control. If almost half the managers aren't even doing it, the company is flying completely blind to potential errors, sudden business changes, or even outright fraud. Let's pivot to something huge that's happening right now. The explosive world of non-financial reporting. The global landscape is all about carrots and sticks. According to the 2020 Carrots and Sticks report, Europe currently dominates the sustainability disclosure agenda, while North America actually has the highest proportion of mandatory reporting requirements. We are seeing a massive structural shift globally. We're moving from voluntary ESG guidelines, the carrots, to strict mandatory regulatory disclosures, the sticks, especially when it comes to climate change and human rights. A brilliant real-world example of this is Marks & Spencer's comprehensive 2020 annual report. They literally call their sustainability plan Plan A because, as they cleverly put it, there is no Plan B for the planet. The reporting goes way beyond basic financial numbers. It includes a passionate CEO introduction, super detailed climate-related disclosures, strict reporting on human rights and anti-corruption, and hard, precise metrics on greenhouse gas emissions. That is exactly what modern, top-tier corporate reporting looks like today. So, I want to leave you with a provocative thought to chew on as you continue your revision. With environmental and sustainability reporting shifting from voluntary nice-to-haves to strict, mandatory legal requirements all over the globe, are our current traditional corporate control frameworks truly prepared to audit this massive new wave of complex data? Keep that critical, high-level thinking dialed in. It's exactly the kind of perspective that turns a good exam essay into a truly great one. Thanks so much for joining me for this explainer, and absolutely go crush those exams.